Hi, this is Karen Dice, publisher of Mortgage Currency, which interprets the rules and regulations for loan officers, processors, underwriters, and managers. Now, this class is a follow-up class that we held a few weeks ago called HARP 2.0. Is it all hype or is it a big help? And this first class has already been posted on the Mortgage Currency website under the video tab. Now, since we had a ton of follow-up questions, we decided to hold this second class today called HARP 2.0. You've got questions, we've got answers. Now, in 2011, there were an average of 22 mortgage rule and compliance updates every single month. And you know, closing a loan today is rocket science. So reading Mortgage Currency, not only keeping you informed, but there's an awesome help desk with mortgage experts to answer your loan scenarios and underwriting questions. And we often provide backup documentation to help you get more loans approved. Now, since the mortgage rules also affect your real estate agents and builders, you have the ability to keep them informed with mortgage talking point articles, automatic Facebook posts, tweets, charts and checklists, and one other cool feature. About 10 days before a rule is scheduled to change, you'll receive an email letting you know so you can review your files to make sure they're not affected by the change so you don't end up with a rejected loan because the rule changed in the meantime. So anyway, let's get started with the introduction of Dan Morales, who is a Fannie and Freddie expert, but he also does what you do every day, originate loans. He knows what you have to go through not only to get a deal in the door, but the huge challenge of getting them approved and closed. So Dan, thanks for holding this question and answer class today, and also, the ability to answer the more in-depth questions asked by subscribers on our Facebook page, which is facebook.com/mortgagecurrency, and we also got some of these questions by email. So Dan, welcome, and a little bit of background about yourself, please.
Great. Thanks, Karen. Glad to be here. Had a great time doing the first call, and just an opportunity to talk a little bit more about HARP. A little bit about myself. I've actually been originating in the mortgage side of the business for about 20 years. I like to think I'm not that old, but I'm definitely starting to feel that. But for the last 20 years, it's been an interesting run to see kind of how the industry's changed and continued to develop. I think what's probably the most interesting to me is how things have kind of come full circle. I kind of chuckle at your comment that it is rocket science again, or it really is brain surgery, because you really do have to understand the technical nuts and bolts of how a loan is made, probably now more than you have had to in the last 10 years. So myself, done it about 20 years. I am a producing branch sales manager. I manage a group of originators and oversee a region for the bank, as well as still originating loans day in and day out. That's still my primary responsibility. It's part of the job I still love. So I do understand the challenges and difficulty of having to document a file and explain rules that don't necessarily make sense to my clients to help them understand why they've got to do some of the foolish things they've got to do as part of the process.
And that's why we love to have you on these calls, because you can explain them, Dan, in regular terms that people can understand. So I appreciate that.
Yeah, no, after dealing with as many clients as I have over the years, you learn real quick to try to find a way to paint that picture in terms that they can understand and follow. But I love to read about the industry. In all honesty, I've got a passion for reading guidelines and rules because I got used to fighting underwriters to prove to underwriters that they were wrong or they didn't know what they were doing. So I certainly see it from a salesperson's perspective, and look for a way to say yes rather than no. Oftentimes, the way to say yes is by knowing your stuff and knowing how a deal can be done rather than knowing the ways it can't be done.
Dan, that brings up another point. When I hired loan originators, one of their, regardless if they were experienced or inexperienced, one of the things they had to do was read the Fannie and Freddie guidelines. They were assigned homework, so to speak, to read chapters, and then on a weekly basis we would review them to talk about the nuances. So I appreciate what you do there in reading the guidelines.
Well, one of the things I like to tell the lenders that work for me is that oftentimes when I would read guidelines to find an answer to something, I would learn something else I wasn't expecting to learn. And when I would read something that didn't necessarily apply to the deal that I was looking at, but it was something where it would almost like my mind would store it like, hey, that's something I didn't know, and I can use that to make money down the road. And so I have a photographic memory when it comes to that stuff. So, you know, some of the articles that we wrote in Mortgage Currency, or some of those mortgage talking points that we've done, are sometimes birthed out of these little loopholes or ways to get a deal done that you know, I learned over the years from reading. So it's you definitely, you know, it's worthwhile to spend the time making sure you're reading the issues we put out, the Q&A issues and good stuff like that, because there's just a ton of knowledge in those, and quite frankly, oftentimes it'll help you put a deal together that you wouldn't have been able to do otherwise.
Perfect. Now, I just want to mention one more thing before we get started. When you registered, there was a link to download the questions that we'll be covering today. So if you have printed that download, I recommend that you take notes as we go along. And if you haven't had a chance to print the questions, you can always go back and print them and re-listen to this class, because it is being recorded, and we'll be posting the video again on the Mortgage Currency website page.
Oh, and one more thing. There are some instances where Fannie's rules are different from those of Freddie's. Most of the time they're the same, so when we answer the questions, we'll give you kind of a breakdown of both Freddie and Fannie, even if they are the same. The handout you have printed has a line for Fannie and Freddie as well, too.
Okay, perfect. Okay, well, let's get started with the first question. Dan, can a person be added to a HARP loan?
Yes. In the case of Fannie Mae, they do allow you to add to a HARP loan. However, the original borrowers must remain on the loan. So Fannie does allow you to do that. In the case of Freddie Mac, if you are the existing servicer of that loan, the answer is no, you cannot do that. If you are a new servicer, yes, you can add a borrower. At least one of the original borrowers must stay on the loan, as well as the fact that the borrower that you're adding cannot be a non-occupying co-borrower if the loan is on a primary residence. So this is one of those cases where the answer is slightly different between Fannie and Freddie. In the case of Freddie, it is different depending on whether or not you are the existing servicer versus whether or not you are a new servicer. So there is a slight difference there, and in this particular case, the existing servicer is actually at a slight disadvantage.
Okay. Now, another follow-up question here. What if there was a divorce? Can they be removed from the loan when it's refinanced using HARP?
In the case of Fannie Mae, yes, but there are some different criteria that do apply. If you are the existing servicer and you're doing a Refi Plus loan, and again, Refi Plus would be where you're not submitting the loan through a desktop underwriter for evaluation. You can remove a borrower. However, you must document that the borrower who's remaining on the loan has made the payments on the loan for the last 12 months from their own cash. Key thing to remember here is if it's due to a divorce, the payments from a joint account with the borrower that's being removed do not count in verifying that 12 months history. So in other words, if me and my wife are married and 6 months ago we split our bank accounts, and for the most recent 6 months she's been making the mortgage payment out of her account, if the 6 months preceding that change those payments were coming out of a joint account, I cannot fulfill that 12-month payment history, and in that case, I could not be removed from the loan. So the devil's in the details there. You got to be very, very careful, because whenever those payments are coming out of a joint account with the borrower who's being removed from the loan, and it's part of that 12-month payment history that you have to document, you cannot count those payments from the joint account. Therefore, that particular transaction would technically be ineligible. In the case of a DU Refi Plus, you can remove a borrower. You have to do the same thing. The same rules kind of apply. One little thing to add there, let's say we're removing a borrower because somebody is deceased. In the case of a deceased borrower being removed, when you look at Refi Plus, you still have to document that the remaining individual made those payments for the last 12 months. In the case of DU Refi Plus, and you're removing a deceased borrower, you do not have to document that 12-month payment history. So that's where it gets a little quirky there. Now, one other thing that is part of what Fannie Mae requires here as well, in either case, whether you're using Refi Plus or DU Refi Plus, or you're removing a borrower, you must remove the borrower from the deed/title as well. So if you're taking someone off, they have to go off the deed and title, and in all cases, at least one of the original borrowers must remain on the loan. Okay, so that's kind of Fannie Mae's breakdown. In the case of Freddie Mac, you can remove a borrower. You have to have at least one of the original borrowers must remain on the loan. The borrower must be removed from the deed/title as well. Now, they go through, and the only little difference here is they're probably a little easier in this particular case. If you're the same servicer, meaning that you are not running the loan through Loan Prospector, you must document that the borrower that's remaining on the loan has made the payment for the last 12 months on both the mortgage that's being refinanced as well as any secondary financing that may be on the property as well. In the case of death, you don't have to go through and verify that 12 months worth of payment history. Now, Freddie is also silent in regards to whether or not payment from a joint account counts, so they don't say anything there. But those are the differences when it comes to removing a borrower between Fannie and Freddie. So again, just remember the devil's in the details, and in some cases you may have lenders that choose to put an overlay in place that say you can't do it, or they have their own set of rules that may be a little more restrictive.
Okay. Next question. It says that when refinancing that there must be a borrower benefit. How do loan officers determine that, and how do Fannie and Freddie look at that?
Most commonly, there's 4 different points, and this is kind of universal between Fannie and Freddie. They're looking at a reduction in the monthly payment. They're looking at a reduction in interest rate, a reduction in loan term, or a move to a more stable product, i.e. you're going from an adjustable rate loan to a fixed rate mortgage. You could technically have the same loan term, same interest rate, and same loan amount, and if you're moving from an adjustable rate mortgage to a fixed rate mortgage, that is still considered a borrower benefit. So at the end of the day, is your borrower having some type of tangible benefit from doing this? In other words, are they seeing a drop in their monthly payment, or are they getting a better interest rate, or reducing the loan terms so they're going to pay off faster? The same stuff we should be doing anyways when we're evaluating whether or not a transaction makes sense for a borrower. That's the same stuff that Fannie and Freddie are looking at there.
Okay. And then, Dan, can a loan be refinanced for terms other than 15, 20, 25, and 30-year terms? For example, I have 22 years left on mine. Can I go back to 22 years?
Yes, you can. Both Fannie and Freddie do allow you to do odd number of years or odd number of months. Again, I would tell you, some lenders, as a general rule of thumb, will say you have to do very specific amortizations. In our case, we will do, and we've had a rash of this lately, where we've had 30-year, customers who took out 30-year fixed-rate mortgages in 2009 that are refinancing, and now they're 2.5, 3 years into the deal, and they just want to refinance for the remaining term that they have left. So I just actually had a comment from my assistant the other day saying, what is it with all these people doing 330-month terms? And so, and it helps to give them kind of a true apple-to-apple comparison when you're looking at what the benefits to refinancing are for them. But technical answer is yes, you can do odd number of months. We've done a number of clients on a straight 10-year fixed as well, too. However, the agencies do allow it. Whether or not your specific lenders do, again, is up to them.
So they need to check with their lenders to make sure it's okay. All right, perfect. All right, next question. Would you explain when a loan has to be underwritten using automated systems versus manual underwriting? There was a lot of confusion out there about this one.
This is actually a very simple question. When you break it down, when you look at Fannie Mae, let's break them down separately. When you look at Fannie Mae, if I'm the existing servicer, I service that mortgage right now, it's on my books, then I have an option. When I'm the existing servicer, it's classified, I can classify that loan as what they call a Refi Plus loan. Refi Plus is just manual underwriting, if you will, meaning that I do not have to use DU to evaluate that loan. However, if I'm the existing servicer, I have the option of choosing whether or not I want to use Refi Plus or I want to process the transaction as DU Refi Plus. Now, the benefit to Refi Plus is there's reduced documentation in regards to documenting income, assets, and so on. However, the one benefit that I typically don't get with Refi Plus is I don't get the ability in many cases to waive the appraisal, because I would have to rep and warrant that there's been no decrease in value since the original loan, which pretty much no lender is going to do that. So what we find ourselves doing is oftentimes we'll actually go through and run a loan through DU, and in many cases we'll get an appraisal waiver, which will mean I don't need to do an appraisal. Now at that point I do have to document the file following DU's findings, meaning that I typically have to get a pay stub and good stuff like that. But that's Fannie Mae when I'm the existing servicer. If it's a Fannie Mae loan and I am the new servicer, meaning that I do not service that loan right now, then it has to be DU Refi Plus, must go through DU. There is no manual underwriting option, so you don't have a choice there. So if it's a new loan to you that you don't service, it has to go through DU, no manual underwriting. If it's a loan that we currently service, that we're the servicer on right now, I have the option of doing a manual underwrite or doing DU. It's at my discretion which one of the two I want to use. Okay. In the case of Freddie Mac, it's very cut and dry. In the case of Freddie Mac, where you are the existing servicer, meaning you have that loan on the books right now, you cannot run it through LP. It has to be manually underwritten, no questions asked. They do not give you the choice. If it's a Freddie Mac loan and you are a new servicer using their open access product, then you have to run it through LP. You do not have the ability to do a manual underwrite. So Freddie's very cut and dry. Existing servicer, you cannot use LP, must be manual underwrite. If you're a new servicer, it has to go through LP, no manual underwriting. And FYI, because I sat in Fannie Mae's conference call in regards to HARP, you can't refi one to the other, meaning that you can't take your Freddie loan and use Fannie Mae's HARP guidelines and vice versa. That was one of the questions that somebody asked, and that's absolutely not possible.
If a loan has been submitted using the automated system, can it be converted to manual underwriting?
In the case of Fannie Mae, yes, you can. You can evaluate a loan through DU and then turn around and convert it back to a Refi Plus loan where you manually underwrite it. Fannie Mae does allow you to do that. In the case of Freddie, no. You're either manually underwriting the loan or you're running it through LP. It's one or the other, depending on whether or not you're the current servicer or the new servicer.
Okay. Next question. If there is a second mortgage, is there a combined loan-to-value limit?
No. That's an easy one, and that's the same for both Freddie and Fannie. In the case of Freddie and Fannie, there is no combined LTV or TLTV limit when there's subordinate financing. The issue you run into, though, is you still have to find a servicer that is willing to, the second mortgage holder that is willing to go through and subordinate that loan. If the second mortgage holder is not willing to subordinate, it doesn't matter. You don't have a transaction.
Okay, here's another biggie. If the home is listed for sale, will it qualify for a HARP Refi?
In the case of Fannie Mae, yes. Fannie does allow you to do a refinance even if the house is listed for sale. Remember, that's HARP only, though. Under their standard refinance program, you cannot do that. In the case of Fannie Mae, HARP, where it's a DU Refi Plus or a Refi Plus loan, you are allowed to do that. In the case of Freddie Mac, Freddie does not give an answer. That's one thing that, and I scoured their guidelines, pretty detailed, and there is no answer there. So I would tell you that when there's not an answer, I would probably default to their standard rules, which do not allow you to do that. The flip side I would tell you is I think it's to the benefit to check with your company's interpretation or with the lenders that you sell loans to see what their interpretation of the rule is. I would think that the spirit of the rule is to allow you to do it, seeing it's a HARP transaction. However, Freddie doesn't say anything in their guidelines anywhere in regards to whether or not they allow it. In addition to that, when they're silent, then I would default to where I can find it in the rest of their guidelines. In the rest of their guidelines, they do not allow you to do that. So that one's a little bit harder to answer in regards to Freddie, but in the case of Fannie, you certainly can do it.
Okay, perfect. And is there an end date for closing these loans, or is it closing or originating when it comes to an end date for the HARP loans?
It's closing. So the note date for these transactions have to be no later than December 31 of 2013. So for a borrower who's going to take advantage of the program, as of current, they have through December 31, 2013, and that's the same for both Freddie and Fannie.
Okay, perfect. And then does the borrower have to be current on their mortgage to refinance using HARP?
Yes, and again, the same answer for both Freddie and Fannie here. The answer is yes, they do have to be current. When they look at the borrower's payment history, they just recently changed this not too long ago. What's going to happen is they're going to look back over the preceding 12 months of payment history. In the most recent 6 months worth of history, the borrower cannot have been late. So for that most recent 6-month period, there cannot have been any late payments. If I look back 6 through 12 months from now, they can have been 1 times 30 in the last year. So you can be 1 times 30 in the last 12 months, provided that 30-day late payment was not within the last 6-month period.
And that brings up another question in regards to, you had a mortgage late payment which affects credit scores. Will there be a credit score minimum for HARP loans?
There's not a credit score minimum for HARP loans. You can find some lenders impose their own overlay, but technically there's not a credit score minimum. In most cases, if you're running the loan through DU or LP, you're going to get findings still that's going to evaluate the overall credit history. And in some cases, you may get findings that don't want the loan. In the case where you're manually underwriting the loan, it's still at the lender's discretion whether or not they're willing to approve that transaction. But there's technically not a minimum credit score, although you'll see many lenders have their own overlays. And in some cases, even if a loan's being evaluated by DU or LP, there's still a lot of lenders that apply their own minimum FICO score overlay because they don't necessarily want to take on a higher LTV loan that is, for lack of a better term, somebody else's problem right now.
So it's really important to know what your investors and your lenders are doing.
Mm-hmm.
Okay, all right. Next big question. How will the home values be determined if there is, if you have appraisal waivers?
Well, if you have an appraisal waiver, let's break it down between Fannie and Freddie. In the case of Fannie Mae, when you run a loan through DU, in some cases you're going to get a property inspection waiver where you don't have to have an appraisal, and in some cases you don't even have to have an actual property inspection. Sometimes you'll get just a property inspection with no determination of value. There's a number of different types of findings you can get with DU. DU will determine what they'll allow you to have. In some cases, you have to have a full appraisal, and in some cases, if you're the existing servicer, you could technically rep and warrant that there's been no decrease in value since the original loan was made. Good luck finding somebody who's willing to do that one. The same thing is true for Freddie. Freddie does a little bit different thing when it comes to determining whether or not you have a quote-unquote appraisal waiver. They use what's called Home Value Explorer, it's kind of their automated home valuation system. As long as you have an HVA value and confidence deviation that's acceptable, you could choose to not do an appraisal as long as it meets Freddie standards. The one thing I would tell you, though, is just be careful. They're not as clear-cut as Fannie Mae, and so if you are counting on HBE to waive an appraisal, just make sure that your lender accepts it and they're familiar with how it's done, because it's not as simple to work with as Fannie Mae's system. With Freddie, you can also choose to rep and warrant the existing appraisal if you're foolish, but in all honesty, in most cases, you're likely going to need either a new appraisal or best case scenario, you get an appraisal waiver. But with the removal of LTVs or the LTV caps as part of this, the appraisal really is more of a tool for determining what the price is going to be on the loan.
Okay, all right. Now I know this next question applies only to some states and some areas, but the question came up, do jumbo conforming loans qualify for HARP?
Yep, that was a great question. I know we had this one as part of the mortgage currency stuff we were doing. The answer is yes, they do. If they're a jumbo conforming loan that was sold to Freddie or Fannie, they would be eligible for HARP. However, in the case of Fannie Mae, and again, Freddie doesn't really spell this out, but I would say I would almost guarantee it's going to mirror Fannie Mae. In the case of Fannie Mae, those loans are subject to the new loan limits that are in place now. So in some areas, there was a season of time where there were some expanded loan limits for conventional conforming jumbo loans, where I believe the limit was 729,000 or something, and now it's down to like 625,000. You can do them, but they're subject to the loan limits that are in place now, which are lower than what they could have been when the loan was originally made.
Whoa, that's going to hurt some people.
Yeah, there's some people that will not be eligible, and that just has to do with the fact that those higher loan limits were mandated by Congress as part of some different legislation, and that legislation has since been expired, so they technically don't have the ability to rewrite those loans with the higher limits.
Okay, all right. Now, I know that there's another huge market that a lot of loan officers aren't really thinking about, but I know HARP also is available for second homes and investment properties. Could you give a little background of if there's loan-to-value limits and what's involved there?
Absolutely. In the case of Freddie and Fannie, both second homes and investment properties are eligible. There is, just like a primary residence, there are no LTV limits that will apply to those. I got to be honest, this is probably one of the areas that is overlooked the most by lenders. And typically, when you find somebody who has investment property, they'll typically have 3 or 4 properties, and you can typically write 3 to 4 loans in one shot. We've done that multiple times. One of the benefits, by the way, when you look at a HARP refinance in investment property, is when you look at the loan level price adjustments, there's a cap to those loan level price adjustments. So you can actually do a refinance on an investment property and still get very attractive terms. Same thing is true on a second home. So in the case of second homes and investment property, there is a boatload of opportunity there that oftentimes is being ignored by lenders because they're just not familiar with those types of transactions. Truth be told, they're allowed. There's no LTV limit, so you can definitely do them.
Okay, perfect. Okay. Okay, here's another one. Can the borrower receive their application fee back in addition to the limits, the cashback limits placed by Fannie and Freddie?
Here's where Freddie and Fannie kind of part ways. Fannie Mae, yes, the borrower can receive their application deposit back, provided that you can clearly document it was paid from the borrower's own funds. So in other words, as long as you can prove that they paid that application deposit from their own money, you can technically give them back more than the $250. Now, just keep in mind that, if they had a $500 application deposit, you can't give them back $1,000 because you would have been giving them back $500 of their own money plus $500 from the loan proceeds. So the portion of that's not covered, if you will, by the application deposit cannot exceed that $250. Okay. I think it's real simple when it comes to Freddie Mac, and I'll just quote their selling guide. Under no circumstances may cash disbursed to the borrower exceed $250. So that's cut and dry as I think they can make it. So even if the borrower did pay an application deposit, they're not getting anything more than $250 back.
Okay, perfect. And then last question, what's the penalty for soliciting refis from existing customers? I know Fannie and Freddie have their own policies, but somebody had asked if there was a monetary fine or jail time.
Well, and I don't think, in all honesty, this is as big of a deal as people make it out to be. And because what happens is, if you're targeting Fannie Mae loans only, if I'm going through, I'm an existing servicer and I'm targeting Fannie Mae loans only, Fannie's pretty specific, being that if the loan is less than 80 LTV, they don't want you to target it. If it's over 80 LTV, you're at free reins to target and go after those customers. So that's pretty simple. In the case of Freddie Mac, Freddie is actually, it's kind of an interesting take they take. It basically just says they don't care if you solicit their loans as long as you solicit them the same way you're soliciting Fannie's. So in other words, if you're going to solicit their loans, it better mirror what you're soliciting with loans that you have that are Fannie Mae's. So as long as you're doing the same thing across the board, they're A-okay with it. So what I would tell you is, one of the things to be careful with is rather than to try to target specific borrowers or stuff like that, just market all of them. You can market all of them across the board. If you're doing general marketing to your entire database of customers, or you're doing a general marketing in a wider format, whether it be print ads, billboards, radio, or so on, you're A-OK to do that. There's nothing to stop you from being able to throw that net out there or to market your current existing customers, as long as you're marketing all of them and it's not aimed specifically at Fannie Mae's customers that are ADLTV or less. Now, as far as monetary policy or monetary penalty, you got me. I don't know. I can't imagine that if you really shook the cage of Fannie Mae, that they're going to be terribly nice to you when it's time to renew your contract, as a lender. So I think, like everything else, play fair, play right, and play nice, and I trust that you probably won't find yourself in too much trouble.
Okay. All right. Well, those are the questions that we had, and so to wrap things up, we have posted on the screen links to Fannie and Freddie's FAQs for HARP loans, and since Fannie and Freddie regularly update them, Mortgage Currency will also keep you updated as new questions and answers have been posted. We will also post updates on our Facebook fan page, facebook.com/mortgagecurrency. And remember, if you're a subscriber, you can ask the help desk, anything you want about your HARP, questions or issues that you might have. And if you're not a subscriber, there's a $1 trial subscription where you can use the help desk during your 7-day time period. So, Dan, thank you so much. Any last words?
Just go out there and write loans. Make money and have fun doing it. Again, thank you for taking the time to listen to the call. And Karen, thank you for having me on to be able to share some information here.
And I want to thank everybody for submitting some great questions.